And I'm going to explain the health risks, potential dollar collapse, potential bursting of the everything bubble in 3 simple, fast steps. Step number 1, let's go over the data. The mainstream media is telling us the coronavirus is just like the flu. It's nothing like the flu at all. The first thing we need to understand is the R0 value. Technically, this is called the R naught value. Very, very important that you thoroughly comprehend exactly what this is and how it works. Editor, let's throw up a chart. The average flu has an R naught value of 1.28. That means after every cycle, one individual passes it on to 1.28 individuals. And this compounds. So whether these cycles are 3 days, 5 days, or 1 week, after 10 cycles, there would be 9 new infections. After 20 cycles, 109, and that would be 494 total infections. Unfortunately, there was a report that came out Friday from a medical institute in China. So if anything, these numbers are understated, saying that the coronavirus has an R naught value of right around 4. So for every 1 person that gets it, they spread it to 4 more people. And through the power of compounding, at the end of 10 cycles, there would be 262,000 new cases. But at the end of 20 cycles, call this 15 weeks, 274 billion new cases, 366 billion total. Obviously, there's not that many people in the world, so if this was not contained at all, the entire world would be infected in less than 20 weeks. And I'm sure you're saying to yourself right now, George, that cannot be possible. But don't underestimate the power of compounding at that rate. At 8 cycles, we only had 16,000 cases. And after 10 cycles, just 2 more, you're at 262. 10 more, 274 billion. And if we go to wooflu.live, which tracks the data in real time, we see this exponential growth happening. On January 21st, there were 440 cases in China. On February 2nd, less than 2 weeks later, we have 17,205 cases total. Going back to the spreadsheet, we see that this tracks almost perfectly with a R naught value of 4. The mainstream media is also telling you that the case fatality rate is lower than SARS. But according to Dr. Chris Martenson, and his website is peakprosperity.com, that's where I'm pulling a lot of this data, so definitely check that out. But according to Dr. Martenson, he says that the way the mainstream media is calculating the case fatality rate is highly flawed. The way they're doing it is taking the total number of fatalities and dividing by the number of cases. So in each one of these scenarios, you would have a 1% case fatality rate. But Dr. Martenson points out that they're comparing apples and oranges. Since the people don't die immediately when they get this flu, you can't compare today's cases with today's deaths. You have to go back, let's say 3, 5, even 7 days, because the people that are dying today were the people that caught it 5 days ago or 7 days ago. When you do that math, you have to look at this week's fatality rate, take it back to last week's fatality rate. When you do that, you get closer to a 10% case fatality rate. And I'm not saying that these are the exact numbers with the coronavirus. I'm just using these numbers to give you an example as to how the mainstream media is getting it wrong. So we know the coronavirus spreads like wildfire, and unfortunately the fatality rate is most likely higher than the mainstream media is telling you. But it gets worse. When we get to the serious complication rate, and this is what percentage of the people that actually get the virus have to go into intensive care like the ICU. With the flu, it's far less than 1%. Coronavirus, 20%. This is a really big deal. And to explore this further, let's go to the Macro Voices podcast with Dr. Chris Martenson.
What happens, and this is the reason I get concerned and why I think it's appropriate to have a measured sense of respect for this particular illness, the kind of care you're going to get before your hospital system is overwhelmed is very different from the care you're going to get after it gets overwhelmed, right? And we saw the images from Wuhan, right? There's people in the hallways, they're lying on gurneys in the hallways, they're getting IVs while they're sitting in chairs. That's the kind of care that you end up getting when a system gets overwhelmed. You're not in your own private room with ventilators and 62 machines that go bing, it's a different experience. And so once I think the serious complication rate comes into play and it overwhelms your hospital system, the case fatality rate now is going to spike simply because you can't put enough care in for people. So let's imagine, just sake of argument, all 115 million of those cases came to the United States. They'll mostly be in China in this 30-day example. And we had 23 million serious complications. I need to put this in context because the United States has just under 95,000 ICU beds in its complete hospital system. Nearly all of those are already full with the usual car accident victims and people who have other end-of-life issues going on or other complications right now. So it's not like we even have 100,000 beds kicking around. But the question becomes, what kind of medical care are you getting when you have tens of millions of people requiring their serious complications to be dealt with when your system is swamped?
The ICU capacity in the United States is right around 100,000. And a lot of that is being used by people that currently have other problems. So if the coronavirus comes to the U.S. with this R0 value as high as 4, that could potentially increase the fatality rate above and beyond just the math equations, because we would be at our limit of capacity to handle more people that needed ICU care. And you can see this happening in China right now. They've got all these live cams set up that actually show them in the process, going 24/7, building as many additional hospitals as they can to handle the amount of people that are contracting this disease. You have to realize that when the World Health Organization comes out with these announcements, they do a cost-benefit analysis, meaning how much economic cost would there be to save X amount of lives. So if they express appropriate concern for the risks of the coronavirus, that could shut down airports, close schools, and really halt commerce, and maybe even lock down a lot of large American cities. And because we're in the everything bubble, the economic damage that would be done is far greater than if asset prices weren't at nosebleed levels. So I'm not saying this is their motivation, but I'm saying it's something that we need to think about. And if they are actually doing a cost-benefit analysis because of the Fed, the costs of doing the right thing are far higher than they otherwise would be. Step number 2, could the coronavirus start a dollar collapse? To explore that further, let's look at how trade works between the United States and China. In the US, we have a lot of consumers, but we don't have many factories. So to get all of that stuff that we need to buy, we have to go to places like China. They're the ones with all the factories that manufacture the things that we need for Walmart, Target, Home Depot, etc. So they send us all of this stuff that they make, and we send them all of these green pieces of paper called United States dollars. The Chinese don't have much use for these dollars because all their expenses are denominated in their local currency, the Chinese yuan. So if the yuan was not pegged to the dollar, and we'll discuss that more in just a moment, they would go into the FX market and sell these dollars in exchange for their local currency to pay their expenses. This creates more demand for their currency, and more supply of US dollars. In other words, the more stuff they send us, the lower the dollar goes and the higher the yuan would go. Insert the PBOC, which is the People's Bank of China. They don't like these free-floating currencies at all. They say, no way, we want to peg our currency to the dollar. So in order to suppress all of the market forces, the PBOC goes to all of the Chinese manufacturers that are getting these dollars from the United States and says, whoa, 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 time out, guys. Instead of selling those dollars into the FX market, why don't you just sell those dollars to us and we'll print up the yuan out of thin air, give the yuan to you, and then you can pay all your expenses. So the Chinese people say, okay, no problem. A dollar's a dollar, a yuan's a yuan. So they sell the dollars down to the PBOC. The PBOC keeps all of these dollars so they don't get out into the system. This creates an artificially low supply of dollars, meaning the value of the dollar is artificially high. If trade between the United States and China slows down dramatically, which I don't think is a stretch. Number one, because a lot of the cities that manufacture in China are on complete lockdown mode right now. And if average Joe Public starts seeing this on his TV every single time he goes home from work, do you think he's really going to want to buy his kid a sweater made in China? I don't think so. So trade would slow down dramatically and would put downward pressure on the dollar. How would that work? Well, the US isn't going to start making all of this stuff overnight. And even if they could, the prices would be astronomical. So they're going to look for an alternative solution. Most likely, they go to other countries such as Mexico that could hopefully produce this stuff that you buy at Target, Walmart, and Home Depot. But there's a big difference between manufacturing in Mexico and China for the value of the dollar. Why? Because the Mexicans would take all of those dollars and exchange them in the actual FX market, opposed to the PBOC that just keeps them tucked away under their mattress. All of those dollars go into the FX market. They get pesos to pay their expenses, but this brings down the value of the dollar. Additionally, domestic prices would go through the roof because there's no way that Mexico can produce things as cheap as China does, or we'd already be buying from Mexico. And let's remember, China buys a lot of US debt. This could add fuel to the fire. If they're not selling as much of their stuff, they're not getting as many dollars, they have fewer dollars to buy US treasuries. You may be saying to yourself, well, George, I don't think that's that big of a deal because China has been a net seller of US treasuries as of late. And you would be right, but what you're not considering is the fact that they roll over that debt. So it's not about how much they're selling, but how much they might not buy in the future. Let's review how that works. My guess is the average maturity on their debt is very short term. Why? Because why on earth would they want to take that inflation risk by buying debt at the long end of the yield curve? I couldn't find any data to back that up. So if you guys have good charts on that, definitely let me know in the comments. But assuming they don't want to take that inflation risk by holding 10-year and 30-year treasuries, and their average maturity is about the same as the United States government, call it 2 years, every 2 years they've got to take those T-bills and roll them over. That means the government pays them actually what they owe them, and then they take those dollars to buy more T-bills from the US government. What if their economy is doing so poorly that they decide not to buy more T-bills because they need those dollars for other purposes? Those dollars would go into the FX market, creating additional supply and downward pressure on prices. Also, interest rates would most likely go up because that natural buyer for treasuries is now gone. But would this create a dollar collapse? For the final word on that, let's go to an article from the finance website, The Balance. If China called in its debt all at once, or didn't roll over its debt, the demand for the dollar would plummet. This dollar collapse would disrupt international markets even more than the 2008 financial crisis. Step number 3, the everything bubble meets the coronavirus. And to be very clear, so far this seems to be a China-centric health issue. Let's go back to WuFlu.live and you'll see the only exponential growth we've seen in the virus is in China. But that doesn't mean that we should bury our heads in the sand and pretend like it could never come to the United States, Europe, or anywhere else. So I think it's very important to see what the PBOC has done as far as monetary policy to try to understand what the Fed might do if in fact this virus gets really bad in the United States. As of yesterday, and that would be Sunday, February 2nd, the PBOC announced that today, this morning, they would be injecting $174 billion into the system to try to prop up the markets. And even with that, the markets are down 8% in China. But going back to the United States, if they close down a lot of cities like they've done in China, San Francisco, Los Angeles, Chicago, New York, Miami, and they made everyone start wearing these masks, shut down schools, what do you think that would do to the U.S. economy? You don't need me to answer that question. And an even easier question would be, what would it do to the stock market, the corporate bond market, and the housing market? Of course, the natural direction of those markets would be a total collapse. So the Fed would most likely come in and do exactly what the PBOC is doing, and that is print an astronomical amount of money and flush the entire system with as much liquidity as they possibly could. The next step to the thought experiment is the yield curve, more specifically the 10-year. We'd have two opposing forces. First, the flight to safety would be creating more demand for treasuries, driving interest rates down. Also, the Fed is creating all of this funny money, taking their balance sheet to infinity and beyond. That creates additional inflation risk, which would drive those interest rates up. So you have the immovable object battling the unstoppable force. Whomever wins this tug of war is extremely important, because if inflation risk prevails, that means interest rates on the 10-year go into the danger zone. That's above 3.5%. We know that's the line in the sand where interest rates really start to have a negative impact on the economy. This would exacerbate everything that's going on with the coronavirus. There's two huge shifts in market psychology that we really need to be thinking about. Number one is if the anti-gold, which is the 10-year, according to Rick Rule, becomes very risky like it was in the 1970s. So it's no longer a safe haven asset. If it's no longer a safe haven asset, interest rates go way into the danger zone, and this could potentially shift the market into a completely new paradigm, meaning that no matter how much money the Fed prints, the markets don't care. They still go down. And I think eventually this is the end game. Whether the market just ignores all the new Fed's money printing, or the Fed paints themselves into a corner where they can't print money any longer. I think this is how it plays out. The question becomes, is the coronavirus the catalyst that could trigger all of this? And for that, you have to make your own decisions. You have to decide what the probabilities are. We know for sure that the health risks are really being downplayed by the mainstream media. We also know that regardless of what happens in the United States, this is going to put a lot of downward pressure on the dollar because of what's happening in China. And that's a foregone conclusion. The cat is out of the bag in China for sure. Now, how this affects the everything bubble is yet to be seen. And like I said, you've got to decide what the probabilities are and make decisions with your portfolio on how to correctly prepare. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.